This is Bram Kanstein, and in this episode of Bitcoin for Millennials, I'm joined by Stephen Perrenod. He's an astrophysicist and technology consultant who spent decades at the forefront of high-performance computing and now brings his deep analytical mindset to Bitcoin and the future of money. Stephen is the author of several books and has been writing about Bitcoin for over 10 years, helping us see the big patterns in technology, energy, and finance. We'll explore some of Stephen's favorite topics, like the math to a 1 million Bitcoin price, why power laws matter more than exponentials, and how to think about wealth optimization in a world of shifting global liquidity. This was a mind-blowing deep dive, and at some times I had to work really hard to keep up. But if there's one thing I'm taking away from this conversation is that Bitcoin is inevitable, because the math just works. Please like this video and subscribe on YouTube or your favorite podcasting platform if you find value in this conversation and any of the other conversations that I'm having on this podcast. This will help me to reach more people and spread the message on Bitcoin. All right, now let's dive into this episode. All right, Stephen Perrenod, welcome to Bitcoin for Millennials.
Thank you, Bram. It's a pleasure to meet you here.
Likewise, yeah. I've been following you with interest. You have an amazing background in physics, astrophysics, and high-performance computing, and you have a lot of interesting takes on Bitcoin and its growth. And so we'll dive into it today, talking about Bitcoin's growth to 1 million. But before we get there, I just wanted to start with your journey and your background. How did that lead you to Bitcoin, and why did you decide to start writing and talking about it?
Sure. Well, there are a few threads. When I was very young, I was a coin collector, and I would go to the bank on Saturdays and exchange fiat paper dollar bills for real silver coins. And I would find some very old coins as well and collect those, So that was real money with intrinsic value. So I have that background before 1971 when we went, total fiat system. And even in the US, it was 1964 when they took the silver out of the coinage. And, I went on to study physics and astrophysics at university and did research in that area for a few years. Power laws are pervasive in physics, and so it's natural to have a background in those and to think in those terms. I then went on to move into the high-performance computing field, and that was where the bulk of my career was, in supercomputing and high-performance computing. And in the past more than a dozen years, I've been doing technology consulting with some of my old associates, a small boutique firm based in Silicon Valley, although I'm in Asia. And we look at a lot of different technologies, and I have an analyst and partner position there. And we came to a point where we were saying, well, who should look at what, And everybody's looking at AI and at quantum computing and other topics. And I said, I think I want to focus on this Bitcoin and blockchain and cryptocurrency area, because the other analysts were not. And I wanted to have something that they were not doing that would make me more unique. So I've been tracking Bitcoin since 2014. And my first purchases were in 2014. And actually, my use case was to move money internationally. That was my initial use case. And I wish I had kept more of what I moved at that time, as we all do. And I went through the typical learning curve. But I think I benefited from having a background in technology and high-performance computing, and also, physics as well, and being able to understand Bitcoin from a multidisciplinary standpoint. So really, the way I got orange-pilled was by reading the white paper. And when I saw in the white paper the Poisson equation, which is the way you compute the probability of a 51% attack, breaking the blockchain, and then I saw that each block before the last block is exponentially harder than the other one, and it becomes quickly impossible to unravel the blockchain. That was it for me. So it was the math and then the understanding of how it all worked together. And of course, I did the usual thing of reading and learning from YouTube videos, and it's been quite a journey. But it was natural for me to have an interest because of the connection with high-performance computing.
Amazing. Yeah, I think what stands out to me there is what you said about how a 51% attack becomes increasingly harder. Does that translate to the probability of this thing surviving gets higher and higher, which if it actually does, it will be what it's proposed to be, right? Like this
Right.
global non-sovereign money.
Well, in part, it's a necessary but not sufficient condition. So it gives you a technology which is unstoppable.
Yes.
But it does not tell you how it scales. Bitcoin Cash and Bitcoin SV have exactly the same underlying technology.
Mm-hmm.
They don't scale in the same way. They don't have the same amount of hash rate. They don't have the same value. The hash rate for Bitcoin Cash is less than 1%, and the value is less than 1% of the original Bitcoin. So the other piece is this network effect, where people were attracted to this because it's the first mover, for one.
Yeah.
Second, because of the immaculate conception, the way it was delivered to the world. And then the fact that it was the first to accumulate hash rate, and it kept getting more and more of the hash rate, and that meant more and more security. And the big challenge was when the block wars happened, I think, in 2017, and this attempt to hard fork it and see who would win. And in a way, it didn't matter. Whichever fork won was going to be the dominant one. But the community decided, and it has scaled, with adoption going something like the cube of time, right? And so it's important that you have these underlying elements in order that people feel safe about it. The first thing you want if you produce digital gold is you want that gold to be secure and locked up. And Bitcoin is its own vault. We have to go out and purchase externally security to store our gold, right?
Mm-hmm.
Bitcoin, the security is built in. Right when it's created, the assay and the vault are built together all at once.
It's interesting. It's like I saw you wrote about the Lindy effect, right? The longer something exists, the higher the probability that it will keep on existing. But like you said, Bitcoin is this reaffirming mechanism to itself, or something, and that I think is very profound. But I like what you mentioned, that there's all these little things that together actually make this profound discovery, in a sense, right? So it's not just the one thing that has to keep on working, but it's all these little pieces together. Yeah, it's after all these years, what's the most surprising thing? I mean, you just mentioned you saw it early, right? And you got it early, but was there anything that later on really surprised you, or that kind of blew your mind?
Well, I'd have to say the power law. I came onto that in 2019. So that was 5 years after I'd been in Bitcoin. And I had looked at things like the stock to flow and other attempts to model. I saw that stock to flow was flawed because by nature it's an exponential, and it was going to grow too fast. So it was going to break within one or two more halvings. So I saw that, and I tried to produce a modification where instead of how much the gold mine produces every year, you look at the total amount of gold in there, and what's its value based on the total amount of the reserves, like you would value a long term for a gold field or for an oil reservoir. And I built a little model like that. It's an integral model rather than a differential model, technically speaking. And it didn't work. It was too conservative. But then towards the end of 2019, I came on to H.C. Berger had a post where he mentioned the power law. And so I came on to it then and said, oh, this is pretty interesting. So I've been working with it since, and only later did I find out who the original discoverer was, Giovanni. But
Bitcoin custody is evolving, and OnRamp is leading this change with multi-institution custody, eliminating single points of failure. Instead of relying on one institution, OnRamp secures your Bitcoin in a cold storage multi-sig vault backed by 3 independent custodians, where no single party can move your funds alone, providing an unprecedented level of security. Your assets are protected by a 100 million Lloyd's of London insurance policy, with all transactions fully auditable on-chain and only executed at your direction. This means complete transparency and control over your assets at all time. Beyond custody, OnRamp provides comprehensive Bitcoin services that include trading, lending, inheritance planning, and IRAs. You can view them as your private Bitcoin banking partner tailored to your wealth preservation goals. Whether you're new to Bitcoin or an experienced holder, OnRamp's approach helps you secure your generational wealth with unmatched security and peace of mind. You can sign up at onrampbitcoin.com and use code BRAM, that's BRAM, to receive $150 in Bitcoin after your first deposit. If you first want to learn more, you can also book a free consultation via their website to speak with one of their Bitcoin custody experts. Tell them you came through me, and they'll take extra good care of you. I've had Giovanni on and Berger also.
Yes.
Those were fascinating conversations. And what I really like is that everyone is kind of like building on top of each other, right? They're using this idea of the power law that we'll dive into now, right? But maybe first start with the definition of money 3.0, because I think there's a fundamental that's a fundamental part of eventually understanding where Bitcoin goes. You call Bitcoin money 3.0, like energy plus cryptography. Maybe it's good we can pull up your
Sure.
slides. You have some slides.
Let me do that.
Maybe start with explaining what does money 3.0 mean in simple terms, and why is it such a big deal?
Okay, how's that?
Yes, perfect.
Okay, so here's the agenda, starting with how I define money 3.0, and then I'll go into the power laws, show the difference between power law and exponential, show that the power law has been very persistent, and there's some statistical measures such as the Hurst exponent and others that you can make in order to demonstrate how persistent it is. This is that Lindy effect idea. And then the distinction between the power law core and the bubbles that we see that are on top of the power law that rise away from and then collapse back to. And then I'll demonstrate that the bubbles have been getting weaker over time, that they've been decaying. And then I have a section on the Kelly log wealth optimization criteria, and that's a way for you to think about how much of my portfolio should I put into Bitcoin. And then I've got the connection between global liquidity and power law, which is, not as clean, but there's maybe some relationship there. And I can close with the 14th semi-annual Crypto Super 500 report. It's a report we do on Bitcoin mining, and it's by analogy with high-performance computing and supercomputing. There's something called the Top 500 report, so it's by analogy with that. So let me leap into the Money 3.0 discussion. Perhaps the first mention that's recorded of energy as money, the idea that you could take energy and use that as the basis for money, comes from a Nobel chemist, Frederick Soddy. He was from the UK. He wrote an article 100 years ago called Wealth, Virtual Wealth, and Debt. And he says that wealth originates from the transformation of energy. Basically, I think we understand that energy is sort of the foundation of our modern economy. He noted also that debt tends to grow exponentially, whereas in the real world, with wealth, we have both growth and decay as processes. And so he called for an energy currency. Others who did that include Henry Ford, also in the 1920s, and more recently, Buckminster Fuller in the 1960s. And then the whole kind of development towards Bitcoin probably started with David Chaum and digital money in the early 1980s. And then there was 40 plus years of various attempts and technology developments that then resulted in Bitcoin in 2008, 2009. Now, I say that Bitcoin is, first of all, true energy money. It's completely grounded in energy. And two, it's fully scientific money in that it's a scientifically precise standard. And it is the first precise scientific monetary standard in history. In fact, there's 15 digits of precision. So we've got this finite cap. It's 21 million or 2.1 quadrillion sats. So that's where the 15 digits of precision come from. Mm-hmm. The underlying law of power is the proof of work, that you have to do real work. And right now, that's about 21 gigawatts per second. Every block is 600 seconds, and then that gets transformed into, well, right now it's only 700 and something exahashes, but it's been as high as 1,000 exahashes. Here's the quote from Buckminster Fuller in 1967. He said, by the year 2000, there will be a realistic scientific accounting system. Wealth is energy. So he was talking about energy money, and he was talking about scientific, at least in terms of try to define it in terms of energy. But in fact, Bitcoin goes further. It defines it in terms of really energy transformation through cryptography of solving the cryptographic hash problem, but then with this precisely scientific standard in terms of the supply. So I call it the first completely scientific standard ledger. That's from my X account, Money or Debt. And the first direct from energy monetary system for enumerating wealth. And in the little chart, I've got the attributes from Aristotle for money, which are the first four: the durability, the portability, the divisibility, and the scarcity. And then I've added fungibility, and then I've color-coded them, my own perceptions of those. Gold was money 1.0. You could say seashells and so forth, and grains of barley were maybe money 0.x. But gold was money 1.0 for millennia. It's been both private and government, and its geography has been both local and national and multinational. Fiat money 2.0, it has very high divisibility. It conquers space. You can move it relatively quickly, but it does not conquer time in the sense that it's always decaying because of the nature of human committees, I guess, varying rates of time, or the nature of politicians, whatever you want to call it. Yeah. But it's always inflating. And of course, it's purely government. And so it's national and multinational in its geographic scope. Bitcoin ticks all the boxes with, dark green, in that it's eternal in principle. You can move it globally in less than an hour, any amount, at very low cost. Divisibility, highly divisible, 15 digits, the fixed maximum, and fully fungible. And you assay it directly within its own blockchain. And it conquers both space and time. And it conquers time by, going up in value according to a power law, or at least certainly going up in value over any long time period. And it's both private and global. So that's my definition of money 3.0.
And the essence of that, if you think about why is this such a big deal? Like for me, it is this fundamental flaw in fiat money that you touched upon, the fact that it is always based on debt. Like you always have to create more. So there's always debasement of all the currently or previously existing units, which eventually makes it unfit as money, at least for the people, right? What is that for you?
Well, I think you're right. Fiat is always comes into existence through debt, and therefore the control is in the hands of a few, and those hands are both public and private hands. The private hands being the loan committees at banks, right? Dominated by the money center banks, and then of course the monetary committees at central banks. And the people who touch the money first get seigniorage. The bankers get the advantage of being able to lend that money out and collecting interest on money that they created out of thin air. So they have that privilege.
Yeah, it's crazy that there's a word for it, by the way, the seigniorage, right? I just, because I remembered, like, the definition is quite crazy. I'll read it because I quickly searched it. It says, profit made by a government by issuing currency, especially the difference between the face value of the coins and their production cost.
Right.
Mind-blowing. Because fiat money, there is no production cost.
It's 2 cents per dollar, you know?
Yeah, crazy.
Yeah.
Wow. All right.
Okay. So then I'd like to move into cryptography underlying Bitcoin, which is now approaching the zettascale. It has passed on occasion more than 1,000 exahashes, which is 1 zettahash. And that, by coincidence, is 10 to the 21. So there's another 21 right there. It's encapsulated energy exponentially hardened onto a permanent time chain. And if you remember your history, the first mining in 2009 started out with CPUs, and then mostly around 2011, people shifted to GPUs, which were significantly faster. And then there was some attempt to use FPGAs, but then it was discovered that one could design ASICs specifically to solve the problem, and those were radically faster. It was a big quantum leap. So the first GPUs, as of 2011, were a few hundred mega hashes per second. But by 2013, ASICs were several hundred times faster than that. And those ASICs, you know, have taken benefit of Moore's law. And in fact, the first ones were not even on the same curve. And so they've kind of caught up. Now they're at 5 nanometer line sizes, and the latest technology for ASIC mining rigs is 300 to 800 terahashes a second. So the per system growth has been a factor of 1 million in 14 years. And the number of mining machines has grown from tens of thousands to a few million. So we've gotten something like 10 orders of magnitude increase in the hash power over the past 12, 14 years. By the way, each hash is not a single operation. There's many operations. It's around 1,600, but they're low-level bit manipulation kinds of operations, shifts and logicals and so forth. So we have these several million mining rigs globally, and I call it the world's largest decentralized supercomputer. And there are tens of billions of dollars of capital investment into that hardware. And the primary foundries right now are TSMC and Samsung for the Antminer, the Whatsminer, and the Canaan Avalon, which are the most popular.
So there are more people, more companies are incentivized, or they see the need or the opportunity, or you know, however they define it, to contribute not only capital but also energy towards securing this network, basically. And you kind of see that in this growth from like CPU, GPU to application specific. The circuits or chips. So there's an incentive for people to actually innovate, to then put this capital and this hardware to work to secure this network. So that's not, you know, the Bitcoin protocol is just an idea, but now this is an idea that's manifested also by the application of all this energy and capital, etc.
It has the incentives built in to attract all that, and those incentives worked, and they developed with a network effect. And you kind of see that in this chart, that distinguishing the Bitcoin Cash. It came about through a hard fork in 2017 and attempted to kind of wrestle control, and was not able to do it. People stayed with the original Bitcoin. And now, you know, the hash rate is something like 300 times faster, or the aggregate hash rate is about a factor of 300 times larger for Bitcoin than it is for Bitcoin Cash. And the price reflects that as well. The value of the blockchain for Bitcoin relative to the value of the blockchain for Bitcoin Cash
Yeah.
And the desire for people to invest in that, both from the mining side and from the ownership side. The ratio of price to exahash is about a factor of 100 in both cases. So it shows you that, it really matters how much energy you put into it. It really is an energy currency. And that energy has to be locked in. It has to be encapsulated. And the way it's encapsulated is through the double SHA-256 hashing process.
Yeah. So maybe an introductionary question, right?
Yes.
So about the power law, maybe some people have heard of the power law or seen some podcasts about this too. So what we are talking about is, this growth of Bitcoin. People are more and more incentivized to contribute to it, right? Like that's what we talked about. But how does that growth manifest? Like, how does it show? How can you perhaps even predict it? And you've often described Bitcoin's growth as being similar to how a city or organism grows. I think you will show something like that. So it's not like a company that could go either exponentially up or down. Mm-hmm. Why is this important for Bitcoin's growth? I think that would be a good thing to touch upon.
Sure. In a word, power law growth is more stable than exponential growth. In physics, we see exponentials associated with decay, with radioactivity, which is a decay process. It's called the weak nuclear force. But, and you see that actually even in biological populations, if they have very rapid growth and then they saturate their available resources, their food or whatever, then you see that they also crash. And so it becomes more like the rise and crashes that we see in financial markets when they get overheated and have bubbles. And Bitcoin has this bubble behavior, but that's on top of an underlying power law. And the nature of power laws is such that the growth is actually modulating over time. It can still be quite steep, and we do have quite steep growth, but it's modulating, and that means you can have a much longer lifetime in existence. Most companies last for 10 or 20 years for the most part. Very few companies survive 50 years without it being acquired or merging or some other highly significant event. The cities last for centuries and even longer. Power laws are everywhere in nature and physics, and this shows several of them. The first equation is about black holes. And, when you think about the Earth or the sun, you think about mass that's related to the radius, the size is the cube, right? It goes like the volume. Not true for black holes. It's a linear relationship, but it's still a power law. The next equation is for gravitational waves, which we see when two black holes merge or a neutron star merges with a black hole. And there's a power law for the time, which depends on the separation. It's quite a steep one. It's the initial separation times the fourth power. So that's an example of a steep power law in nature. The next one has both a power law and a decay associated with it. That's why you have this log term, but there's a 1 over gamma. And this is a cross-section for matter-antimatter collision. And then the last one relates to the Higgs boson, and it relates to the field strength and the energy. And it has both what we call quadratic terms or square terms. Phi is this field strength squared, and it has higher terms to the fourth power. So we just see these everywhere. All four of the fundamental forces are either pure power laws or have power law aspects to them.
If you want to self-custody your Bitcoin stack, I recommend the Blockstream Jade Plus. I've been using this premium Bitcoin-only hardware wallet for a few months now, and I love its design and ease of use. What makes it stand out is its open source hardware and software, and Blockstream's unique genuine check, which makes sure that your device is authentic. No backdoors or compromises. You can connect with the Jade Plus however you want. Bluetooth, USB-C, or you can go fully air-gapped with its built-in camera for cable-free QR transactions. The metal case feels solid and the color screen is easy to read. And it connects with your favorite Bitcoin apps like Blockstream Green, Sparrow, and Electrum. Get your Jade Plus today at store.blockstream.com and use code BRAM to get 10% of your entire order. Let's talk about something that not a lot of people think about before it's too late. Where are you storing your Bitcoin seed words? Are they truly secure? I found my solution with Stampseed. It's an elegant all-in-one titanium plate solution with no separate pieces to lose or manage. Your seed phrase gets permanently stamped into pure titanium that withstands fire, survives water, and lasts for generations. Unlike shallow etching methods, Stampseed's patented tools help you to deeply stamp every letter for permanent readability, protecting your financial legacy. When you order a titanium seed plate from Stampseed, you can also upload a custom design or your logo to customize the back of your plate to make it fully personalized. Paper seed phrases are a disaster waiting to happen. Secure your Bitcoin with Stampseed for decades to come. Visit stampseed.com and use code BRAM, that's BRAM, to get 15% off your order.
So I want to show more explicitly the difference between exponential and a power law. And it depends on how you plot them. So here I have the same curves. That is, the orange lines are the same equation, and they're an exponential. And the blue lines are the same equation in both plots, and they're a power law. With an exponential, you have two parameters, and those are, if you look at that first line of text, C and T sub C. C is just a constant, it's just a scaling. The T sub C is important. It's the time scale. So there's a characteristic time scale when you have exponential. In decay, if you have a free neutron, it's going to decay on average in 10 minutes. It's not exactly all the time. It's a statistical process, but that's the average. So there's a characteristic time, which is exactly 10 minutes, and just by coincidence, it's equal to the average block time, right? Now, if you plot that on a log linear chart, that's a straight line. So the y-axis is logarithmic, the x-axis is linear, and the exponential is a straight line. The power law is not, it's curved. If you move to a log-log chart where both axes are logarithmic, and we're talking about time as the x-axis, then the power law is a straight line, and the exponential is curved and steepening. The power law has two parameters as well. It's got a C, which is a scaling, so that's as before, but it doesn't have a characteristic time. It's time raised to some power k, and k is the power law index. So one is an exponential scaled to some temporal time scale, and the other is scale-free. It's time raised to some power. It could be a square, could be a cube, could be something else. In our case, we're talking about high powers, like 5 or 6. So it's important when you look at graphs to see, is this a log-linear plot, is this a linear-linear plot, or is this a log-log plot? Because different relations will display differently on those. So you could have them tangent at a certain point, and if you have a small enough distance, they might both fit for that short distance, but eventually they're going to look quite different. Here's an exponential. So it follows that equation. I've got a log linear chart. So I've got a log of the price of something, and I've got a linear time. And you can see there's a straight line. And an exponential fit is also the same as constant CAGR, compound annual growth rate.
Yeah.
And in this case, it's the S&P 500 since January 2009. And it's grown at 11.9% constant. And that's a time scale for doubling, which is about, 7 years, between 6 or 7 years. So that's the characteristic time scale for doubling it. To grow exponentially is this, base of the natural logarithm. It's a little bit longer. It's more like 10 years to grow by that factor of 2.78. But this is a classic case and very typical of what you see in the stock market. You see a lot of exponentials. Now, you'll see things, rise and crash and so forth. But over long periods of time, they'll tend to have a compound annual growth rate. And then as a company matures, that growth rate will slow. Now, onto a power law, two parameters. Of course, this is Bitcoin. it's very important when you measure power law, you have to define your zero time. And so our zero time is cleanly defined for us as January 3rd, 2009, when the blockchain began, when the first Genesis block was created. And on this plot, it's a log-log plot. We have the log of the price, we have the log of the age, and for convenience, I've also written the linear age below. So you see 2, 3, 5, 10, 16 years. And you can see how it's getting, for the same interval, the number of linear years is increasing, right? In other words, the space between 2 and 3 is not that different from the space between 10 and 16 because it's a ratio. It's a ratio of about 1.5 or 1.6.
And why is the log so important to look at it like that?
Because the straight line pops out at you. Right? This is a linear regression, this black line, of the data since the beginning of 2009. It's a linear regression fit. And it's a constant growth rate. But if it's a log-log chart, you can do a linear regression, and then it's a power law, and it's not a constant growth rate. Growth does slow over time.
Okay.
In fact, you can see that. Look at what the price was at 2 years and 5 years. That's a factor of 2.5, and the price went from, under $1 to around $100, right? If you look at, say, the black line, which is the ordinary least squares regression, that's a ratio of 2.5 in time. Now, let's take that same ratio going forward. You go from 5 to 12.5. That puts you around 2021, in between the 10 and the 16. What was the price? A little above 10,000. So it's the same multiplicative ratio, but a lot more time has elapsed, right? Instead of 3 years elapsing, 7 or 8 years elapsed.
So my understanding of the power law, and I think you have more to show, but something that seems random, as in the adoption of a technology, like you cannot really predict that. I mean, conceptually, you don't really know if an idea survives, right? I always talk how that is a huge signal in general, right? The fact that Bitcoin still exists after 16 years. So is a power law something that kind of like follows, I almost want to say, like a natural order, although it seems random? Mm-hmm. Like, does it matter what happens along the way? Like we had this with the block wars, the China ban, the mining ban, there's several things that happen along the way, maybe Bitcoin strategic reserves, whatever. It could be good or bad in narrative, right? Does that matter? Is that randomness just accounted for? Is that just the path? Or like how should you look at that? Because it's really hard to predict what people will think of Bitcoin or how they will issue policy, or I don't know.
Yeah. So the way you think about it is that the power law is the underlying relationship of the network, which is not to say that it isn't influenced by events. So there's signal and there's noise. And the power law is the underlying signal. And then the noise are the departures that happen because of events. It could be regulation. It could be ETFs happening. It could be the strategic Bitcoin reserve. It could be more liquidity in markets in general. And you get these bubbles. But the test of the power law is if you have a bubble that rises exponentially, and even in its later stages, faster than exponentially, super exponential, we call it, and then it crashes, does it come back to the power law? Or does it go, much, much below? And what we've seen is that it comes back to the power law. So the black line is the ordinary least squares. The dashed lines are quantile regression. The red line is the median for the quantile regression. And so that, of course, is incorporating the variability. And what you see is that below the median lines are tight. They're tightly spaced. And that's what we're going to call and introduce as the power law core. That is the long-term support. And you can see that each of these lines is a power law, right? And they have slightly different slopes, but the ones that are in support are have very similar slopes. You know, the bubbles cause the upper lines to depart a little bit from that in what their slopes are, but they're also all converging onto the same thing.
Yeah. So when you call this a signal, is it then a fundamental signal? This is how I translate it in my head. Is this a fundamental signal that this is allowed to exist in the world? I don't know. I'm going to call it like that, right? There's a peak, there's a sell-off, and then it comes back to this. I think it was the black line, right?
Yes.
Or the red one. Like it comes back there, which means it didn't die, right? Like there's still people that adopt it in whatever way. I mean, that's a general argument that a lot of people are like journey that people share. Like, I saw Bitcoin, it went up, then it went super down. I totally ignored it. Then 4 years later, I was confronted with it again. I realized it was still alive, and that actually piqued my interest of going into it.
Right.
Is that how you should look at that signal, in the sense that it shows you that it's still alive? It's just continuing.
Right. It shows you the persistence. And of course, it will fall below the mean or the median line, but then it will find support. And that support is also, of these lower dashed lines, is very similar to the 200-week moving average as well.
Oh, interesting.
Which other people have noted is a good support line.
I think what I find hard to understand is why does it converge, basically? Because that means like diminishing returns, right? There's a whole discussion, I think, around that. For example, people that follow stock to flow, they talk about exponential S-curve, technology adoption, etc. I think the power law really shows diminishing returns, which I think is the only thing that I cannot really wrap my head around, as in, I think adoption-wise, we are still very, very early, and there's still a lot of capital that can flow into Bitcoin. There's, several people like Jesse Myers have this great compilation of like how much wealth is there in the world, what is the monetary premium on real estate, and etc. And conceptually, it's the idea that when more people realize Bitcoin is a superior financial asset, more of this capital will flow and be stored into Bitcoin, which makes me think, the most capital is still to come. How do we connect that to these diminishing returns? Does that mean it just takes very long for all this capital to come in, or how should people look at that?
Yes, in part. I mean, look, it takes more and more capital every year. Right now, the growth trajectory for the power law is about 41% per year. And if the value of Bitcoin is $2 trillion, then it has to increase by 820 billion in market cap over 1 year. Now, it doesn't need that much capital. It needs some fraction of that.
Yeah.
And
it's set at the margins.
That's right. Right. And that's the market multiple discussion. And that market multiple, it seems to be like 40%. In other words, a ratio of 2.5, something like that.
Yeah.
Average over long term. You look at the MVRV numbers, basically. And so you need, 820 billion divided by 2.5 to come in. But next year, you're going to need roughly 40% more capital coming in than this year, right?
Yeah.
So that's the
rate.
challenge. You already need large amounts of institutional capital coming in to sustain the power law, never mind to cause an exponential bubble above it.
Yeah.
In fact, the capital growth is itself a power law of index 1 less than the power law of the price.
Yeah. Maybe another noob question before we continue.
Yeah.
How do you account for the absolute or the limited supply in that sense? So I follow what you're saying about this inflow of capital, right? The prices are set at the margin where people trade, right? Like what they think is an appropriate price. But with Bitcoin, we have something that, in my mind, adds something to it, which is this limited the absolute supply, and you see the hodl waves, right? Like how many people have not, how much Bitcoin hasn't moved in 1 year, 2 year, 3 years. I think 3 years is at like 55%. So, that's you and me. We know what this is. We don't sell. How do you account for that? Or how could people think about that? Because my simple mind thinks, there's going to be kind of like a supply squeeze in that sense.
We're already in a supply squeeze. I mean, the amount of capital that's going in is much more than the production now, right? So
that's true.
Right. Okay. So all we're seeing is primarily some people selling and other people buying. So we're seeing institutional buying, and who's selling? Basically a few whales that have held for a long, long time are taking a little bit off the table, is what it seems to be. And there are studies that have been done that show that the whales tend to sell the tops, and the retail and the mid-size tend to FOMO and to buy, momentum. And then the whales come back in when there's pullbacks. Okay, so if you do the fit, then the power law index is like 5.7 or 5.8, depending on what exact regression technique you use. It doesn't matter too much. You get a straight line, you get this movement around the straight line, but it's skewed, you get more upside with the bubbles than you have downside. So that's good. You've got support. And the point is that it's a high index. So you're still getting very high return, just if you stay on the power law trend. So for example, next May with the ordinary least squares, the projection would be 135K, and that does not account for any possible bubble. Okay, you can apply this to gold, and that kind of answers two questions. Sometimes people say, well, you're measuring it in dollars, and fiat is increasing the dollar supply. M2 goes up 7% on average or long term. And my response to that is, yeah, but we're going up 41%, so 7% is second order effect. It's in the noise. But you can also show the same power law nature by measuring Bitcoin price in gold. And so this is a log chart of Bitcoin in gold ounces, from over pretty much the full history. And you see the same thing. It's just that the power law is a slightly lower index. It's about 5.5 or so. And you see the good support, too, with the lower quantiles as well. And that's what we call the power law core, those lower 3 lines or so. So there's 7 lines here, but 3 of them bunch up very tight. So that's your kind of hard support underneath. And then the bubbles up above. And as we know, gold only increases by about 2% in supply each year. Here's another demonstration that Bitcoin is not following exponential. This is just looking at the return for each epoch. So I've lumped all of the monthly returns in each of the 4 epochs that have been completed through, April of 2024. And the orange line is the average return per month. And the blue line is the volatility, which is the standard deviation across that 48-month epoch. And you see that both of those things have moved significantly, have declined significantly. So monthly return went down from 30% on average to something like 7.5% in the last epoch per month. And volatility dropped from 80% to 20% monthly volatility. If it were following exponential on average, it would be a constant compound annual growth rate, which would be a straight line across this chart. And this is a test for the stability of the power law and also how it became kind of locked in. So, it's like a new engine starting up, and it kind of, is not in its rhythm yet, and it hiccups a little bit, and then it locks in. And that happened around the years 2011, 2012, 2013. So if you take the data only up to a certain time and say, what would I have measured the power law to be? beginning of 2011, you would have measured it to be 8.4 as the power law index. The slope in this log-log chart would have been steeper. And it went even higher with that 2011 bubble, and then it dropped back. And before the 2013 bubble, at the beginning of 2013, it dropped all the way to 5.3. And then it went up again with the 2013 bubble and came down again, and you see a little wave with the 2017 bubble. But essentially by 2016, by roughly 10 years ago, it was pretty locked in. So it's had a power law index that's been around the 5.6 to 5.8 for the past decade, roughly. And the band shows the uncertainty that you measure. So it's a very small uncertainty as time goes on. So this is a direct measure of this kind of Lindy nature.
Yeah. I think I have two questions here. What do you think about the fact that it already was there in 2016? This is new for me. I find that very interesting. As in, then it's seven years old, already maturing in a sense, if you look at what that is right now. So the fact that it's so stable already so early, what does that tell us? Maybe not even 2016, but I think also even now, if you think in general, just global adoption is still, I think still very low.
Right.
But this shows a very stable, continuous path, basically, of adoption.
Right. The underlying theory for this is that it's a social network. We're seeing network effects, Metcalfe's law, and Metcalfe's law goes roughly as a square or a somewhat lower power law index of the number of participants. In other words, with the growth of the adoption, which you can roughly measure with the number of wallets, crudely. And in fact, Giovanni first noticed the power law around 2013 when it was showing an index then of 5.3. So he happened to notice it, which was kind of astounding. And, he projected forward 5 years and said, what will it be like? And, it proved out because 5 years later, it was a power law index of, 5.5, 5.7, something like that, 5.6.
Yeah.
So part of it is this network had built up to a sufficient scale that it was manifesting itself.
Yes.
And the same thing happened with the internet. The internet followed a power law for roughly 30 years. From around 1990 to around the beginning of this decade, you can characterize it as a power law. And by 5 years ago, it had saturated because by then everybody was on the internet.
Yeah. Maybe that's a good thing to touch upon. Like where does this end? Is that when there is, air quotes, enough adoption, whatever enough means in a quantified? How can we look at that?
Yeah, we don't know, but where it ends, there are different conceivable endpoints. I mean, I view it as a series of hurdles that it's trying to reach the market cap of all gold, which is 10 times from here. And then another hurdle would be, actually right now the US M2 money supply is similar to the market cap of all gold. But another hurdle would be the global M2 money supply, which is a little over 100 trillions, right? So will it reach all gold? Will it reach all, the equivalent of all the money in the world today, which is sufficient to denominate all of the wealth in the world today?
Mm-hmm. Yeah.
Currently, you denominate nearly 1,000 trillion in wealth. You denominate it with about 100 trillion of M2 currency, fiat currency. So I think those are hurdles and objectives. Other people say, well, it's going to absorb a lot of the monetary premium in real estate and so forth. I sold some real estate so I could have more Bitcoin. So it's doing that. But we don't know. We don't know how far it's going to get. It's certainly encouraging to see all of the movement with the Bitcoin treasuries as of late, right? And that seems like, boy, that's got a lot of momentum behind it. You can test this, and I have done it with something called a Weibull distribution, where you put, ultimate endpoint as, say, 30 trillion as a future gold value of all gold, and 100 trillion and 300 trillion. And if you build those models, you find out that statistically they're no better than a straight power law model. So that suggests that the power law has a long way to go. It's not going to stop at 10 trillion. But beyond that, it gets more speculative.
Yeah, I think it also has to do with how much do the people adopting this technology understand what it can do, right? If it eventually is the measurement of value of the entire world, in utility, how much does it have to be worth in order to become that utility? I think that's kind of like a circle reason, a circle that you can go in, but that is up to the people that adopt it in that sense. Is it then also good, because you mentioned that before, that this actually does not grow in an exponential way, although a lot of people would want it to grow in an exponential way? Does it mean that if it grows in following a power law, it's actually much more cemented into certain systems, the world, financial systems, however you want to call that? Like, is it actually a better way to grow following the power law because of that? Or how do you explain
I believe
that notion?
So. I believe so. First of all, the fact that it's growing as a power law demonstrates that what we have is an underlying network that's growing. And so that gives people some confidence in the stability. The power law itself is a manifestation of stability. On average, people tend to shy away from volatility, right? And so particularly institutions need to risk manage, and they want to control volatility. And so I think as volatility comes down, large institutional capital is more likely to enter into Bitcoin, or even its derivatives like preferred shares, built around things like STRK that my strategy has introduced. So decreasing volatility is good for adoption, I think.
Yeah, it's interesting when you think about just the bell curve of adoption that has percentages, obviously, but it's more about the personalities of the people that make up the cohorts. And for some people, the newness and the high volatility is something that they are very familiar with. But for the vast amount of people, they only adopt something when the perceived risk is lower, right? Or the volatility, if you define it like that. So the risk of choosing to adopt a new thing is low enough for them to actually do it. So that's kind of where my head went when you shared that, because I think it's a constant kind of back and forth between what are the incentives for certain people to then adopt something, right? And there's different conditions for different types of people to adopt it. And I think the volatility here is one of them. Yeah.
Okay. There was a paper written in 2021 that looked at whether Bitcoin adhered to the efficient market hypothesis, which is often applied to stock market returns, saying that they're mean reverting in the long run. There are a bunch of statistical tests that you can do. The ones that are in bold are ones that I've applied to Bitcoin, but there are a number of others as well. And in that review, they looked at 25 articles, and 20 of them said, no, Bitcoin is not mean reverting. It does not adhere to the efficient market hypothesis. So what we're saying with the power law is that you have a permanent source, or at least a long lifetime for a source of alpha, of outperformance, of non-efficient market hypothesis. None of these guys knew about the power law theory or looked at that. So once you apply that, you get an even stronger demonstration for it. And I've done that with the Hurst exponent.
So it's literally the contrarian trade.
Right. It's
interesting.
Always contrarian. And that's what I want to show here with the Hurst exponent. So this was introduced in 1951. It has a power law nature to it. It's been used in a lot of disciplines. It was introduced for hydrology, but it's been used in physics, complex systems, neuroscience, geophysics, finance and economics, and also of relevance, network traffic, internet traffic. And what you do is you have to detrend and get some residuals, and then you have to chunk them up into various sizes. And you want to see how it behaves as you change the window size. And what you're looking at is the ratio of R, which is called the range. So how wide is the range? There's some details behind it we don't need to get into. And then the standard deviation, which is the size of the fluctuations. But that ratio of the range over the fluctuations, the standard deviation, itself should behave as a power law of the window size. And so you get something that's called the Hurst exponent H. And so normally it should lie between 0 and 1. And if H is 0.5, you've got random walk. If H is low, you've got the thing we showed on the prior slide, mean reverting. And that's what the stock market looks like typically. If H is larger than 0.5, you've got long memory, you've got an inefficient market, you've got persistent alpha. Here's a study that somebody did comparing both emerging market stocks and Bitcoin in red, emerging market in blue, to look for this exponent H. They did find it was persistent. It's above 0.5, although it never reached 0.75, except for more than a moment or two. It's a pretty long study, 8 years of daily prices. They excluded weekends because they were comparing to emerging markets. It was more persistent than the emerging markets that also showed a Hurst exponent above 0.5. So this is some earlier literature. There were one or two other studies, kind of similar results. However, in order to do their residuals, all they're doing is looking at the difference of price from one day to the next. And I said, well, actually, the residuals are from the power law. The power law is the underlying trend. And so I'm going to look at the residuals away from that underlying trend. So that's what I did. First, I took the power law with this quantile regression at 0.5. You can do it with the ordinary least squares. You'll get similar results. And then I applied the traditional method for the Hurst exponent. So it's the log residuals relative to the underlying power law. In other words, if the price went twice as high in a bubble, that's a log 10 of about 0.3. So that's what was being used for the residuals. I looked at the full price history, both weekly and daily, and I looked at both measured in dollars and measured in gold. And the X's here, the data values, or actually the results for the Hurst exponent. And they're marked either with D or W, depending on daily or weekly. So what we found is that for both against dollars and against gold, and for both weekly and daily, we got very high values of the Hurst exponent, basically 0.9 or higher. And in the case of daily, where we had more data, more than 5,000 points, we actually got higher values. So those are the ones with higher statistical significance. 0.96, 0.97 is extremely high for a Hurst exponent. You don't see anything like this in stocks. So what we've got is very strong persistence, a highly inefficient market, source of alpha, non-reverting. If you do it for 10 years of the SPY, the S&P 500, the H is 0.18. It's down below the bottom of the chart, which is at 0.5. Yeah. Strongly mean reverting.
What I take away from this is I don't wonder what you think. Is this why a lot of people in finance don't understand
this is
Bitcoin also?
This is it.
Or like just money or assets in general? Like this is because people use the S&P 500 as their benchmark, right?
Well, not only that, the way they study it is they look at the daily price ratio, the price changes, right? So they look one day to the next. And what they're effectively doing is they're detrending with an exponential. In fact, I did another test with DFA as a related method. They're detrending with an exponential because that's the nature of the asset. That's the way it behaves over long periods of time. And so they're just looking at percentage changes or the log of the daily changes, the ratio. They're not looking with respect to some underlying fundamental thing that's going on.
Yeah. What I love that philosophically it comes back long and short time preference. Actually, it's how you look at something, right? And if you look at it with a short time preference, you will basically get different results. And if you then, make that your benchmark, you make that your paradigm, and you cannot really view this new thing for what it actually is. Yeah, interesting.
Yeah, a lot of the studies of Bitcoin, they'll look at 1 year of data, maybe up to 5 years of data. They won't look at the whole thing usually. Then I said, how does this Hurst exponent break down over time? How does it change? And I had to go to hourly data to get good enough statistics. And we see that for the whole span of the history, over up through age 16, it's well above 0.9. So the effect is very, very persistent. So I call this proof of alpha. And so I was doing 1 year windows and I was stepping 1 quarter at a time. And the color coding is just whether it was in the core or the bubble. When it's in the bubble, it kind of drops down a little bit. But when you get back into the core, it goes back up because you're seeing more of the parallel and less of some exponential contribution. And random walk is way down here at the bottom, 0.5.
Wow. So my rookie translation is Bitcoin has always been a good trade.
Correct.
Wow.
It's always been a good long-term trade.
Yeah. Very cool.
And then we want to look at the residuals because we want to think about this parallel core in the bubble. If you take the log residuals for the full history, you take out a power law to build those, then this is the probability density. This is a histogram of how they're distributed. And first of all, you see that, it's very skewed, right, with a long right tail. And so you can try to approximate it with a gamma distribution. However, it doesn't fit the first peak well, which is really the parallel core. And it also misses this dip that you see just after the 0 level of the log 10 residuals. You can better fit it with the dual Gaussian model. So the green Gaussian, and this is really log normal because it's log 10 residuals, but the green Gaussian is the parallel core and the red one is the bubbles. And it works in the dollar and it works versus gold, which is shown in the right-hand chart. And you can do something called, I asked ChatGPT, what do you think about this? The bimodal Gaussian mixture model is a much better fit than the gamma model. So it agreed because it misses the left tail and over smooths on the right. You can also do a hidden Markov analysis and it shows you which phase are you in. Are you in the parallel core phase or the bubble phase? And so it color codes those. And you can see there's a very nice clean separation between those. Once you enter the bubble, you tend to stay in the bubble for a long time until you crash back down. And then once you're back in the core, you tend to stay in the core for a long time. You've only had very small breakouts, a couple of mini bubbles that you see there. Now, if you take out the bubbles and only look at the parallel core, so that's half of the data, and then you redo the analysis for ordinary least squares or quantile regression, this is what you get. It's an extremely tight relationship. And the R-squareds are 0.99, over 0.99. So very, very tight fit for the core power law only. Now, this is back including the bubbles as well as the core. I've actually pulled out the transition zone. So I've used the upper 40% for the bubbles, the lower 40% for the core, the transition zone for the middle 20%. And this was just trying to show, have we entered a bubble or not? And at the end of the last year, we kind of entered the bubble. And then, as you know, our Q1 was not so exciting. So when you get back up, when we're back up around 109, 110, then we're back into entering the bubble phase.
One question about the previous one, the R squared. This means that it's highly predictable.
It's highly predictable for the core. It's also highly predictable, but with larger standard deviation for the whole data suite. But the core is extremely predictable. Very, very low standard deviation here.
All right. So if we understand that there is this continuous path of adoption and that the price slowly increases at a certain CAGR, what does Bitcoin to 1 million actually look like in terms of adoption, energy usage, etc.? Like how in what type of time frame can we put that?
Yeah. Sure. Well, what we need to get to 1 million is we need for it to double a little over 3 times, right? And right now, the doubling time is about 2 years, but getting a little longer all the time. So to get to 3 doubles is going to be about 7 years, and to get to 1 million is going to be about 8 years. So I think on the power law core trend, it's about 2033. It could happen sooner with a big bubble. And I'll show you some kind of forecast trends that take into account the nature of the bubbles and how they're declining and the power law core. And this slide gives you a setup for that. If we just look at the core, that's the green line, and this is showing what the uncertainty is, the standard deviation. It's been flat. So if you just look in the core, it's about a 20% standard deviation. I use a rolling 4-year average to kind of smooth things out. But if you look in the red line, that's the bubbles, and we see the standard deviation has dropped very significantly from over 100% down to 40%. And right now, according to this best fit curve, it's about 37%. So these two are approaching each other. In other words, the bubbles are getting less energetic, lower standard deviations. And you can actually fit that with basically a reciprocal relationship where it's falling roughly as 1 over the age of Bitcoin. A little bit of an offset so that you don't go to infinity at the origin, but it's basically a reciprocal. So if you then take the quantile regressions and you take what I just showed you on the last chart, and then I have this kind of new forecast method that says, okay, what's the bubble mean? Not just what's the power law core mean, but what's the mean for the bubble? And then what's the standard deviation size for the bubble? And then look at the right side of the bubble, the +1 standard deviation and the +2 standard deviation for the right tail of the bubble is where your extreme prices can be. And given that that's only half the data in the bubble, then that means you've got about an 8% chance of being 1 standard deviation on the right side and only about a 1% chance of being 2 standard deviations. So you shouldn't expect much more than that. And in fact, if you think about a bubble as 2 years, the +1 standard deviation is something like 8 weeks of possibility, and the 2 standard deviation is only about 1 week of possibility. So if you look at, just a year from now, then the bubble mean would be about 150,000, and the 1 and 2 standard deviations would be 210 and 265. So that's kind of a path. If you want to know how the power law core develops with time, it's a very simple relationship. I don't have it here, but you just take the inverse of the age, you add 1 to it. And so if the age is, say, 17 at the end of the year, you take the inverse of that, you're at 6%, right? 1 over 17 is about 0.06. You add that to 1, you raise that to the power law index, which is 5.8 in our case. That number is the ratio of price increase for the power law core. So, for example, I just told you, just kind of off the top of my head, that 2033, right? So if we say the middle of 2033, 8 years from now, that will be age 24 and a half for Bitcoin. We're age 16 and a half now. Bitcoin will be about 50% older than it is now. You raise that ratio to the 5.82 power, it's a factor of 10, 9.98. We're at 100,000 now. So the power law core basically says at Bitcoin age 24 and a half, if it's right on that, median line, will be right around $1 million. So that's the path that the power law sets.
It's interesting to think about how people will adjust over time. I think, also when you got into Bitcoin, I don't know if you ever had discussions about the 100,000, right? I had many discussions about, the 100,000 is going to melt the internet, right? That's when people are really going to figure this out. Now we are over 100,000, and interest has never been this low from just
retail interest. But corporate interest has never been this high.
That's very true. Yeah. But it's more like how, with every stage, there's different people that adopt it, I want to say. But I also think like the higher the price, the less bigger groups of people cannot afford one Bitcoin, right? So when I think about what is this predictability, it's so crazy to see that there are so many variables, so many things that can happen. But with what you showed me also about this predictability, right? There is a predictability, and it would be really amazing if we do hit the 1 million in 2033 and then look back at this conversation and just everyone working on this and the calculations just really showing that despite whatever is going to happen in the next 7-8 years,
right,
it actually happened. We actually got there. And I think that at that point, or hopefully also along the way, this is what will wake more people up to, this is actually a thing. Still at 100K, there's so many people that say it's a Ponzi or, pyramid scheme or scam or whatever. Whereas with, the whole power law stuff, it shows that, and I think that's not highlighted enough, and you mentioned it a few times, it's a network. It's a growing network of people that adopt a better money. That's basically it.
So that spreads, from person to person. That's the way networks spread. I mean, I don't know how many people you've orange pilled, but as you know, people only come to Bitcoin if someone quite close to them, either a close friend or close family, gets them there. I have a business professor. He's retired already, but he's a professor emeritus. He did really well because he put all his money into Buffett's company, into Berkshire Hathaway. He's got a lot of money. We've been talking about Bitcoin for 10 years. He still doesn't get it. Get it.
And he knows you.
He knows
right?
me.
That's always exactly.
One of the world's fairly knowledgeable people. Yeah. So but it doesn't take everybody. Going from 50 million people to 100 million in the network is roughly takes the value up by the square of that, by the a factor of 4, right? Metcalfe's law again. So okay,
interesting. It's like a virus.
It's a virus.
yeah.
Should we talk about Kelly?
Yeah.
Criteria?
So if people either understand, I understand to a degree, or at least when they see it, right? Mm-hmm. When they see there's a predictability to the growth of Bitcoin, this is person by person adopting a better money, person by person or company by company adding capital, energy, their resources to it to keep it decentralized and secure, as we talked about in the beginning. If you understand all of that, or at least see it to some degree, how much should you allocate? That's the big question. And you are a big proponent of the Kelly criterion.
Right. So Kelly criteria came out in the early 50s, and Kelly was a co-worker with Shannon at Bell Labs, and Shannon is the father of information theory, and wrote the formula for the entropy of information, and studying communications networks and how much signal can you get in the presence of noise. Well, there's an analogy in gambling or in investing or in staking into something. And it turns out that there's a utility function that you want to maximize the log of your wealth. And I won't go through that, there's not time, but the idea is that people feel loss worse than they feel gain. And in fact, there's a foundation for that, because if you lose 50% of your money, you need 100% just to get break even on your next trade, right? So you want to maximize the log wealth. So the idea is that you make a bet or an investment, you win some percentage of the time, and there's a payoff ratio. It could be even, or your win could be larger on average than your average loss. And then from just the P and the B, the percentage of wins and the payoff ratio, there's an optimal fraction of your portfolio. If you got $100,000, what fraction should you put into Bitcoin is the question at hand for us. So here's what the curve looks like. This is a case where you win 60% of the time and your payoff is equal to your loss. And it says in that case, you'd want to bet 20%. So if you had 100,000 portfolio, you'd put 20%. But this is an even bet. You don't have an advantage on that side. You only have an advantage in the probability. But you see the shape of that curve, it can take you into negative territory. Once you get to $38 out of 100, you're going to lose money over time. And it's not the optimal bet. The optimal bet is the percentage of wins minus the percentage of losses, which is 60% minus 40%. And that's why it's 20%. Now, if your win payoff is larger, then it can be a higher amount. So here's what it is for the major asset classes. There are 16 asset classes here. There's 10 years of annual return. And those of us in the Bitcoin world know that Bitcoin has won most of those years, right? It's the blue on the top, the dark blue. It won 8 out of 10 years. It also was the worst asset at the very bottom, as we also know, if you've been around, for 2 out of the 10 years. Nevertheless, amongst all these, it turns out to be the premier asset. Now, half of these are bonds. They don't return that much. And so I didn't analyze those. I analyzed basically the stock components and the commodity components. So then I think we've got 8 here. 1, 2, 3, 4, 5, 6, 7, 8 categories. Bitcoin, broad tech stocks, small and large caps, real estate, which are REITs, gold, commodities, and international equities. And you can just pull off from that chart what the probability of winning was. It was highest for Bitcoin at 0.8, but it was also high for small and large caps, etc. And then you can pull off the average winning percentage, which is the W, the average loss percentage, which is the L, and then the B is the ratio of those two. So for Bitcoin, it's very high. It's 4.2. Now, as we know, Bitcoin's on a power law, and we know the returns are very high. And so I've also got at the bottom just the last 5 years of Bitcoin. If we say, okay, I don't expect to see 1,000% returns anymore. And so for the last 5 years, you still had a 0.8 win, but the payoff ratio was 2.27 rather than 4.2. So the classical Kelly formula says you take P, the winning percentage, you subtract the losing percentage, which is just 1 minus P, and you divide that by this ratio of B, which is the advantage you have of larger wins than losses. Mm-hmm. And that becomes the optimal portfolio percentage allocation. And for Bitcoin, it's 75%.
Wild.
Wild.
Okay. And so that is wild in a sense that I think it's scary for a lot of people as well.
Yeah.
Like if this is correct, right? That's a very big thing to do. So what is like the ideal time frame to look at, I want to say Bitcoin's returns or Bitcoin in your portfolio? Like when you allocate 75%, what should your time frame be to basically not be shaken out along the way when your perceived loss, because you have of course the bubbles, that you get shaken out.
Correct. So it turns out that for the Kelly, you have to make an assumption about when you rebalance. So this is based on the annual returns and therefore annual rebalancing. If you use monthly rebalancing or quarterly rebalancing, the Kelly fractions are much lower. So you would find yourself in the case with quarterly, it would be in the, as I recall, it's a little less than 50%. It's in the 40 to 50% range.
And so you have to hodl.
You have to hodl. This tells you to hodl.
Yeah.
And if it's monthly, it's down around 20 to 30%.
Yeah.
So it tells you that the longer the time frame, the better. Now you could say, well, why not use 4-year time frames? But then the problem is I only have 4 data points, right? Mm-hmm. So I don't have good statistics.
Yeah.
But if I use annual data, even if I use just the last 5 years, it's 0.71. It's 71%.
Okay, so this question is still open, or the answer is still open to this question then, but I like that it comes back to you have to hodl, right? It's again short time frame versus long time frame.
Answer is hodl.
There's only
for 1 year or more. You know, really you should hodl for 4 years or more. But 1 year should be your rebalancing window, roughly.
Fascinating.
And, you know, you don't have to pick January 1st. You could pick your birthday, whatever.
Yeah.
Now, you can correct for the risk-free treasury bill rate or something. And what you find is it doesn't affect the Bitcoin allocation much at all. It does affect some of the others. In fact, some of them flip from positive to negative.
Negative.
It's amazing.
Wow, small caps.
Real estate.
Real estate.
And small caps go flip negative. Commodity.
Okay, wait. So negative. if you this is Bitcoin the last 5 years,
right?
So if you held Bitcoin for the last 5 years, and this is basically then the real rate of return.
This is not the rate of return. This is how much you should allocate.
Oh, sorry. Yeah, but keeping in mind,
yes,
the treasury rate, right?
Yes, subtracting the treasury rate.
Yes, you see that. Well, actually, real estate stands out to me, or commodities and real estate stand out the most to me. I think.
Correct.
Those were bad investments.
Correct.
Bad ways to store your wealth.
Over 10 years, yeah.
Wow.
Yeah. That's amazing, huh?
That's amazing. That's mind-blowing, yeah. And that's, again, I'm thinking like we are still so early. Mm-hmm. So how does this develop? You know what I mean? Like the fact that there's... Like, does this get higher once more people adopt Bitcoin? Because if more people adopt Bitcoin, I mean, we talked about this recursive feedback loop, right? If more people adopt Bitcoin, it actually strengthens the network, becomes more safe, becomes more predictable, lower entropy, etc. Mm-hmm. More energy is stored, basically, which I think the predictability in my mind is the thing that you should pay attention to, right? Or the predictability of the continuity or something like that. Does that mean that this becomes higher in that sense? Or how do you think about that?
I think we don't know. Because we're dealing with the statistics of 10 years, right?
Yeah.
So, and the problem is if you go to quarterly or monthly and you get statistics, more numbers, but then it says go with a lower allocation. So it's suboptimal. I think what for me is compelling is that the power law is locked in and that when you remove the bubbles, it's very, very tight. And when you compare to see whether the power law index is dropping, you don't find that yet. So we continue to monitor and maybe we'll see the power law index decrease some and flatten out. but the volatility is also coming down. So I don't know how this is going to develop. I think we have to see how the Kelly fraction develops.
Very, very interesting. I wanted to ask you a few questions to round up, because we just like my question about absolute scarcity, right? Like, is that a factor? You've also talked about global liquidity. I think you have a slide or two maybe on that, because the meme in Bitcoin is that the debasement of fiat money is mathematically assured, right? And the absolute scarcity of Bitcoin is mathematically assured. In my mind, the global liquidity rising constantly is, of course, a factor in the debasement of money, in the flight to other assets than money. People talk about Lawrence Lepard, about the big print, the acceleration of global liquidity, like money printing. How do you factor that into everything we talked about? Is that like an outlier thing that is happening that could have a big influence, or is that also accounted for in a sense?
I did a bunch of studies, and I used the OECD M3 global liquidity because that was data that I had access to that's available at the Federal Reserve site. And I looked to try and add to the power law what's the influence from liquidity, and also what's the influence from change in liquidity. And what I found was, and I don't have time to go into all the details here, but what I found was that if the liquidity jumps significantly above 7%, that tends to happen before bubbles and maybe helps trigger the bubbles. It doesn't carry the bubbles. It doesn't cause all of the big rise of the bubbles. That's caused by investors hurting and trading and FOMO. But it seems like there's correlation to trigger the bubbles, the change in the liquidity. And it precedes by actually a fairly long time frame, by 6 to 12 months. And we did have liquidity pick up and then sort of flatten out and then pick up again. So we may have favorable liquidity situation right now. It seems that we do. And I did see something where M2 globally maybe was above 7%. The M3 numbers, the availability lags a little bit. So I don't have that yet. I don't see that yet in the M3 numbers. So I think there may be some trigger for bubbles in the liquidity.
So maybe to wrap up this part, if you see that as a trigger, right, for bubbles, is the thing to think about bubbles, maybe that's not necessarily something that's mathematic, but more like psychological, right? You have this classic graph of what is that, like despair and faith, and like that it goes up and down. It isn't that just the way to look at it? In a sense, there's stuff happening like money printing or people finding out about Bitcoin, they're slowly studying, etc. And some people adopt it at the bottom, some people adopt it at the top, right? And then their behavior changes as it goes. Is that just more like the psychology factor? Because it's also like with every epoch, right? We see there's like a little step change. There's a lot of people that adopt it, some people drop off, but the eventual result is that more people adopted it, and so on and so on. Is that how you would describe that too? So there's like this mathematical part, and then there's like this psychological part. It's kind of like unpredictable in a sense.
Well, yes and no. There is a psychological part for sure, and Sornet has studied this, and he divided it into small, medium, and large traders, and he found that the large traders were the smart money, and so the small and the medium size tend to buy into momentum, and the large traders would tend to sell at tops a little bit and then buy back in depressions and troughs, whereas the dumber money was selling at the wrong time. So there is that effect, and he showed that. And there's some academic, papers on that. But the same guy, Sornet, also has a log periodic power laws, which can be used to study bubbles in financial markets. It's been used for earthquake studies and other things as well. And it's a way of looking at the waves that develop in a bubble. And it's a complex model. It's got 7 parameters. It's not like the power law, because the power law is this, in fluid dynamics terms, you got this steady laminar kind of flow, whereas in the bubbles, we've got this turbulent flow, and it's a lot harder to model something like that. So you need more parameters. He's got 7. And so it's got this kind of power law rise component, but then it's got this oscillatory component. And then the oscillations come closer and closer together until you hit a critical kind of really super exponential runaway. And with that model, you seem to be able to estimate, at least in some cases, when the bubble will hit.
Yeah, interesting. I think this adds for me just the enthusiasm to keep on following this. And I think you are the same, just in general, being in Bitcoin. I feel like I have a seat in the stadium and I'm just watching this unfold to see where it's going to end up, and that's just entertaining. Entertaining is always the word I use. Like, it's just very, very interesting and very intellectually stimulating also, just to see, is this really what we think it is? So I'd love to wrap up with, over your career, you've seen massive changes in technology and finance, and just wanted to ask you, like, how does Bitcoin compare to other major tech and financial innovations that you've witnessed? Like, what would you tell the audience about how to think of the profoundness of Bitcoin or the importance of Bitcoin?
Yeah. So I guess 3 technology areas that I've witnessed have been how high performance computing and supercomputing have developed, how AI has developed, and to some extent how quantum computing has developed. And of course, I lived through the kind of tail end of the transition away from, as a kid, the transition, or even as a young adult, the transition away from the Fiat system. In the case of high performance computing, I've seen us go from megaflops to exaflops. So I did my thesis work on one of Seymour Cray's machines that he developed at Control Data before Cray Research was founded. And it was about a 1 megaflop machine, 1 million floating point operations a second. Sounds extremely slow these days. Now the fastest supercomputer in the world is 1 billion. So it's gone up by a factor of 1 trillion. During the times since I did that and through, my experience, and all the architectures changed. You had special purpose architectures. You went to general purpose architectures. The same thing has happened in Bitcoin, but more rapidly, whereas you went from CPUs to GPUs to FPGAs a little bit, and then to ASICs, and then very rapid development of ASICs. So we've had the same sort of Moore's law development, and that took us from mega hashes up to hundreds of exahashes a second. So it was the same, factor of 1 trillion in hash rates, but instead of it happening over more than 4 decades, it happened over a decade and a half. So, technology is speeding up, right? That's kind of the experience that we've all had. The internet, I was an early user, an early user of email long before there was web browsers and so forth. The web browsers were developed at a supercomputer center. Even the original HTTP protocol and so forth was developed at CERN, the particle physics lab. So we've observed all that, and we've observed AI. AI's changed in nature tremendously because it started out being about inference, logical inference. I remember going to a conference in the early 80s at Stanford, and it was all about if-then-else logic, trying to build rules for things, and they were able to build chess-playing programs and so forth. But the big revolution has been the last 2 decades, really, with the neural net-based and deep learning-based. And so there was a huge transformation around that, just like there was a huge transformation of the internet once we got web browsers ubiquitous and then started layering on some other functionality, at the turn of the millennium.
Does this align with what people talk about, like Bitcoin is growing faster than the internet also in that sense? Because when you just said that, like building on top of it, I do think we lack some stuff there. Like I would have expected more stuff to already be built upon it.
Yeah, we need things like the lock protocol. Yeah.
Working on it.
Yeah. So look, the best software is layered. TCP/IP. There's a whole 7-layer architecture for networking, right? And so you layer FTP on top of TCP/IP and HTTP on top of that, and other layers on top of that for e-commerce and so forth. The best software is layered, and Bitcoin is started to develop some of its second layer protocols, and we need more. And as we need more, that will invite more people. It will make it more transparent, easier to use.
Yeah, I agree. All right, let's wrap it up with my last question. And I ask everyone the same question, which is, what is a core belief that you will never let go of?
A core belief that I will never let go. I don't know. If I get stripped down to the core, it's about mathematics,
Okay. All right. Well, thank you so much. Thank you so much for this conversation. It was very interesting. I hope the people listening found it interesting. And I'd love to do this again. Keep in touch. Let's see how it develops, and we'll do an update sometime. But thanks so much for sharing your wisdom.
When it's suitable, and it's been my pleasure to be on with you, Bram.
Likewise. Thank you. I hope you enjoyed this episode. If you did, you can click here to find more just like it, and click here to find all Bitcoin for Millennials podcast episodes. Also, please like this video if you want to help shine a light on the message of Bitcoin, and subscribe to my channel to stay connected. I hope to see you for a next episode. Bye.